those topics which are mentioned are very, very important. This chapter alone will give you approximately 5 to 7 questions in the actual exam. Fine. Very highly you can say important when we talk about the coverage or the scope of asking the questions. 5 to 7 questions directly, 0.5 marker, or for that matter 1 marker. That is the nature of the questions which you can expect. So overall, the marks which you can expect from this chapter, it will vary 3 to 4 marks. Okay, 0.5 marker, 1 marker, like that. Seldomly they ask from this chapter having the 2 marker. Fine. 2 marker are not that high from this particular chapter, but yes, 0.5 marker chances are really high that you will find a good number of questions. So what are mutual funds? Anybody who wants to have a discussion, who wants to share that what do you think about the mutual funds? Simply stated, we have studied the mutual fund in the initial lectures, also in the initial chapters also of module D, where we have defined that mutually some stakeholders, they will be coming up and they will be sharing the investment, and they will be sharing the investment, and ultimately what we will be having, we will have a fund known as mutual fund. So it starts off with the very basic thing that number of stakeholders are there, S1, S2, S3 and so on till Sn. All of them will pool the funds. Fine. So fund pooling will be there, and ultimately the pooled funds clubbed together will be known as mutual fund. That is how the basic things work. But what about the definition? What about the institutional framework, institutionalized framework of your mutual fund? All these will be learning in the chapter, unit number 41. So it starts with the definition and the functions of mutual funds, the management of mutual funds, how we distinguish the trust, the sponsor, the promoter, or for that matter, who will be the AMC here. All these terms are very, very important when you talk about the management of mutual funds. Evolution of mutual funds in India, very important. The 4 phases in which the evolution happened, and all the 4 phases are important. From these 4 phases only you will be able to solve the 0.5 marker questions. Fine. They ask repeatedly the questions 0.5 marker from these 4 phases. Then comes the classification of mutual funds. Various types of mutual funds are there. We have the debt, equity, hybrid. Fine. They have their own types. Then open-ended, closed-ended funds. Fine. All these are what the classification which we'll be studying. Then who will be supervising these funds? We have the AMFI here, we have SEBI, we have specific trustees here. So who will be doing what? The supervision of the mutual funds. What is the role of mutual funds in the overall economy? How it benefits us when you talk about the mutual funds? Then we have the new fund offer. Whenever something is being scrutinized by the SEBI, you will have certain regulations. Fine. The regulations will be in line with the new fund offer, and this particular offer only will provide you the ultimate return. Fine. The returns are huge, the returns, but again scrutinized by SEBI quite strictly. The risks associated with the mutual fund, as they say that this is suitable for those who want to have their funds locked for longer term. So how the risks are there, whether we should lock our funds for the longer term or not. Then we have the risk depiction also. So depiction, how the riskometer will be there. Earlier there was no such riskometer, but then SEBI came with this particular aspect. They wanted to inform the investors that yes, how the risk works, how you will be able to understand the risk involved in each and every fund. Then how you judge the mutual fund, whether it will be beneficial or not for you in longer term, via the concept of NAV, net asset value. Then we have the expenses ratio, the load, no load funds. If you can enter and exit in a particular fund with paying some amount, then it is a load fund. If there is no need of any kind of payment, no charges are there, then no load funds. What are the strategies for the investment in your mutual funds? The strategies involved, the most important one, your SIP, strategic investment plan. Then we have the SWP also. Fine. What are these? We'll be learning in this chapter. Role of mutual funds in the capital market, and lastly the AIF, the alternative investment funds. All these topics form the syllabus of your mutual funds. More or less you should focus on only few topics from where questions are asked, like the initial ones. From here you can expect good number of questions of 0.5 marker. Then question is there from riskometer also they ask. NAV we will be covering in the initial part only. Then we have the alternative investment fund and the strategies for investment in mutual funds. All these are also important in your mutual funds discussion. Fine. So in case you have not studied anything about the mutual funds right now, you must focus on the discussion which we have done right now. Okay. Whenever there is something we are not at all having the access to, like the mutual funds, wherever we don't have the access, you will find that the mutual funds are not at all under the purview of an investor. They are also unable to gather the information for the same. But whenever you have the access of the funds, or for that matter you can make an informed choice, then net asset value will help you out. But whether only net asset value is important? No. You need to have good amount of other aspects also. The arrangement should be like that only. So we'll be learning all these things, but let's for the very first time try to define the mutual funds. What is this mutual fund? So as I just told you that these are just the pooling of the funds, and the definition of this is the same: mechanism for pooling the resources from the public by issuing units to them, investing the funds so collected in securities in accordance with the objectives as disclosed in an offer document. So offer document of a particular company will be there, that yes, this is the offer document, and we will be having the pooled funds, the pooled resources utilized on the basis of these objectives. Fine. So the public will be pooling funds, will be providing the funds, and that will create what? Asset of that particular fund. Like SBI mutual fund is there, so n number of investors are there. Who are they? The individuals only. Fine. Along with some entities are also there, but majorly who invest in these funds? The individuals. Fine. So they will have the corpus as the asset. Then there will be certain liabilities, and these asset minus liabilities will give you what? The ultimate unit value, which that is AUM, and which will ultimately give you the NAV. So like that we'll be learning that how the NAV is also calculated. So what we are trying to say is that by issuing the units to the public and investing the funds so collected, whatever the funds you are collecting from the public, you are investing those particular funds in the securities. What kind of securities? Debt, equity, hybrid. Fine. So in accordance with the objectives, whatever the objectives are. So yes, that's how we define the mutual funds. And when we talk about the role of these mutual funds, they perform important role. Everybody must be knowing that role of financial intermediary by mopping up the savings from investors and channeling them towards the productive investment. Whatever the productive investment is there, they will be making it. And more or less, they also form a dependable avenue for those investors who want to invest in the capital market but keep away from it due to lack of expertise. Whenever we talk about a mutual fund, you won't be able to invest until and unless you have the expertise. And in case you are a fresher, or for that matter you have not invested much earlier in the capital market, you can, via the advice of these mutual funds or the dealers who are dealing in these mutual funds. Who supervises mutual funds? Supervised by SEBI. and there are various types by which they can be classified. We'll be learning about the classification also. But more importantly, mutual fund, they issue what? Whether they issue shares, stocks? No, they issue the units to the investors in accordance with the quantum of the money invested by them. Whatever the money has been invested by the investors, you will find that mutual funds will issue them the corresponding units, the units proportional to their investment. Investors of mutual funds, they are known as unit holders, right? All those individuals who are holding the units, right? Unit holders. The profit losses of the fund or the plan, they are shared by the investors in proportion to their investments, right? More or less, mutual funds is for what? It is for those individuals who want to raise money, but they also need to have some kind of knowledge. If not, if they lack expertise, then it will be a very hard, you can say, trade which they are doing. Fine. Like in treasury bill or in the bond, they already know. Fine. Investors know that how the bond will be there, what will be the amount involved, what will be the amount involved in the treasury bill. But here in the mutual fund, it is not at all, you can say, declared, and you have to time and again go with the market trend and accept that whether the fund is going up or not. Fine. So dependable avenue, yes, it is for those investors who want to invest and have the lack of expertise, but again, in the longer run, you must become an expert. So functions of mutual funds, more or less, it starts off with the investors who pool their money. So pooling of the funds will be the first criteria from where the mutual fund starts. One fund manager will be there who invests these pooled money in the securities. Securities, we have majorly debt and equity. Income and the dividends now generated, right? Once the manager invests the pooled money in the securities, so there will be some earning via income. Income is distributed amongst the shareholders, and again the money will be pooled in order to create the fund for the investment in the securities. Now comes certain terms which you should remember, which form the important aspect of the overall management of the funds, mutual funds, the management of mutual funds. So the terms are sponsor, who is also known as the promoter. You have the trust and the trustees. You can have them as the guardians of the fund. The AMC is their asset management company, who is considered as the brain behind this entire setup. Lastly, you have the custodian. Fine. The custodian who will be having the direct linkage with the SEBI, the market regulator. So when you talk about the sponsor, who is a sponsor? Simply stated, sponsor will be that entity who starts the fund. Like you have various types of examples. In case of SBI, the State Bank of India decided they wanted to offer mutual funds to the public. So who will be the sponsor? SBI. Simple. The terms you should remember, you should understand via the examples only. So the sponsor is more or less a promoter itself. Who is a promoter in a company? If I ask you, there is a vision. Fine. One vision is there, and this vision is that we want to provide the spectacles online. Fine. Online spectacles we want to give to our buyers. Right? This is the vision. So who was this visionary? We remember the visionary's name as Piyush Bansal, right, of Lenskart. But whether only Piyush Bansal was involved? No, there will be some other persons also, some other individuals also who share this vision, fine, and were important part of implementation of this vision, fine. So the face, that is Piyush Bansal, and the others who also helped initially in the business, who were having the same opinion as the owner of the company, they clubbed together will form the promoter. So the owner, those people sitting and having the idea finalized, everybody clubbed together will be known as promoter. Something like that you can say is the sponsor. in the mutual fund. So the sponsor is the parent or the entity that gets the license from SEBI to start a mutual fund. They must have a track record of integrity and financial health. And there must be a track record of financial health. It's not that you don't have money and you are sitting in a tea shop discussing that yes, we should start pooling the money, and without any source of income on your own, you go to the SEBI and say that yes, we want to launch one mutual fund, release one mutual fund. Thing like that can happen. You should prove that you have the financial health. Real life example, SBI, supposing SBI decides that they want to offer the mutual funds to the public. So the sponsor will be whom? The SBI will be your sponsor. Key rule, they must contribute at least 40% of the net worth of the AMC. What is AMC? We'll be looking into that also. But right now, just have this data in your mind that at least 40% of the net worth of AMC should come from the sponsor. At least, right? They can contribute more also, but minimum is 40%. Then comes the next element in the entire management. It will be the trust and the trustees, who are also known as the guardians. So the mutual fund, it is registered as a public trust under the Indian Trust Act 1882. More or less, the trust is all those trusts which are there in our country. They will be instated via the Indian Trust Act 1882. And when we talk about mutual fund also, it is also registered as a public trust, right? We have the registration in the name of a public trust only whenever we talk about mutual fund. So the trustees, they are like police who ensure that AMC doesn't take unnecessary risk with your money. So who is this AMC? More or less the particular agency who will be doing the investments on your behalf, fine? So trustees will keep a check on these AMC that they are not taking any unnecessary risk, fine? And why the trustees will do that? Because the mutual fund, whatever the mutual fund where the investment is happening, it is registered as the public trust. Example will be SBI Mutual Fund Trustee Company Private Limited. This is the real company, real life example. If the AMC wants to launch new scheme that is too risky or against the SEBI rules, the trustees have the power to stop them. So you can say indeed they are the guardians of the investors. They hold the property of fund in trust for the benefit of unit holders, fine, that is the investors. So they will be holding the property of the fund, whatever the property is there. And what is the rationale behind holding this? It is to benefit the unit holders. Whether there will be independence or not. So yes, to ensure that no insider trading or bias is there, 2/3 of these directors must be independent, right? Not the employees of SEBI, of your SBI. So whenever we talk about SBI Fund Trust Company is there, Fund Trustee Company Private Limited, here the insider trading should not happen, fine, within themselves. If the individuals are trading, so what is the purpose of launching a mutual fund? Fine. So in order to ensure this, 2/3 of these directors must be independent, right? 2/3 of the directors who are sitting in this company, they should be not an employee of SBI. That is, they should be independent. So these are certain regulations which are involved in the management of mutual fund, especially for the trustees. For all of them, there will be some regulation, but yes, for trustee, we have the 2/3 regulation. Next comes the AMC. The actual investors' money will be handled by the AMC. So the asset management company or the AMC, known as the brain. AMC is simply the professional firm hired by the trustees to actually invest the money. They employ the fund managers who watch the stock market every day, fine. Ultimately, on ground, you will have the fund managers, but who will take the responsibility of such act? Your AMC, asset management company. So for this example only, SBI Mutual Fund Trustee Company Private Limited, you have the AMC as SBI Funds Management Limited. These are the real companies, right? So the action, how it occurs, when you see an ad of SBI Blue Chip Fund, the most renowned one, or SBI Magnum Tax Gain, it is the AMC that is designing the strategy and picking which stocks are to buy, fine. So the ad of your SBI Blue Chip Fund, or for that matter Magnum Tax Gain, why it is being promoted? So that we can have more investors in these funds, and in order to have the more investment in this particular fund, you require to have a strategy which will be designed by the AMC only, asset management company, and will also strategize that which funds we should pick, which stocks, whether the stocks of Reliance, HDFC, TCS, or some other company which is doing good profits, fine. Independence, at least 50% of the AMC's directors must be independent. Again, in case of AMC also, you should not have this thing that all the employees of SBI only are the directors. No, 50% of these AMC's directors should be independent, not a part of SBI directly. Then we have the custodian, known as the vault also. Who will be the custodian? More or less a third party who is not involved with the SBI directly. So this is the critical layer of safety. Simply stated, custodian is there to have your funds safe, to provide additional security apart from the trustees. So the AMC, which is known as the brain, is not allowed to keep the gold or share certificates in their own office, which is very, very important. Fine. The AMCs can trade on your behalf, but they cannot retain the securities in their own office. They must be kept with SEBI registered custodians. Fine. SEBI registered custodians, like your JP Morgan, we have the Stock Holding Corporation of India, SHCIL. These are what? The SEBI registered custodians. So why this additional layer or the critical layer is being instated by the SEBI? If the AMC, your SBI Mutual Fund Management, which is just an AMC, goes bankrupt, they cannot sell your shares to pay their own office rent. Right? Just imagine a situation where the SBI Funds Management, they go bankrupt. Now, if they are holding the securities, the shares of yours, they can directly do what? They can sell them off and pay their rent, the office rent, because the shares are physically or digitally sitting with them. But with this additional layer of custodian, you will find that since these shares are with the custodian, you are unable, the AMCs are unable to do the same. Right? So the custodian will be holding, and it will be monitored by the SEBI only. Fine. SEBI registered custodians are only allowed to do the same. Fine. So I hope that the management of mutual funds is clear, that who is the custodian, what is the role of AMC, what do we mean by trust, who are the trustees, and your sponsor. Fine. The keywords are very, very important: promoter, guardian, brain, and your vault. Now let's see what all important role the SEBI has in each one of these under the management of mutual funds. So more or less, SEBI is the regulator of your market, but again, a mutual fund is set up in form of trust only, which has your sponsors. They have the trustees, asset management companies, and the custodians. So STAC, this framework of the trust you should remember as STAC. Fine. STAC, sponsors, trustees, asset management companies, and the custodians. The trust is established by the sponsor or more than one sponsor. Fine. So here we have seen that who was the sponsor? SBI. Fine. So they will be doing what? Establishing a trustee company. So here also the same thing is written. Trust is established by a sponsor or more than one sponsor if there are multiple sponsors. Who is a sponsor? They are just like the promoter of a company. The trustees of the mutual fund, they hold its property for the benefit of the unit holder. Fine. So they are holding the property. What kind of property? The commercial property, the real estate? No, the funds we are talking about. AMC approved by SEBI manages the funds by making investment in various types of securities, debt, equity, bonds, all these. Fine, various types of securities are involved. Now comes the last part, that is C. In the STAC framework, we have C also, that is your custodian, who is also registered with SEBI, holds the securities of various schemes of mutual fund in its custody. Who is moving these securities? Who is trading in these securities? Your AMC. But where are the securities? Where securities are with the custodian. The trustees are vested with the general power of superintendence and direction over the AMC. They only have a general power, right? Not absolute power, only the general power of superintendence over the AMC. That yes, they will be looking into the activities which the asset management company is doing. They monitor the performance, compliance of the mutual funds to various regulations laid by the SEBI. SEBI will be laying down the various rules, regulations, right? SEBI regulations, they require that at least 2/3 of the directors of trustee company or the board of trustees must be independent. So this we have already seen, that the board of directors in case of trustees, you will have 2/3 as the independent one. Right? Independent means the particular trustee company should not have their own employee as the directors. Fine, 2/3 should be from other companies. That is, they should not be associated with the sponsors. Fine, like we have seen the example of SBI. Also, another thing is 50% of the directors of the AMC must be independent. Fine. So for AMC as well as for your trustee company, we have good number of stipulations. For the trustee companies, 2/3 should be independent. For the AMC, 50% should be independent. So in the STAC framework, STAC, you have T and A with specific ruling of SEBI that they must be independent. So trustees, 2/3 directors should be independent. AMCs, 50% of the directors should be independent. Now you will ask that what is the number of directors in AMC and number of directors in your trustee company. So it depends upon the company setup. Right? Whatever the number of directors are, we only need to know the percentage of the independent directors. Right? So when you talk about the independent director, normally we find that they should not be an employee of the office like trustee or for that matter AMC. Not associated with the sponsor, that is very important. No association should be there. Has no material financial relationship with the AMC that could interfere with their objective judgment. So conflict of interest should be avoided. This independence primarily is done with why? Because we don't want any conflict of interest. This should not be there. Now comes the ultimate agenda of the entire chapter, that what is this NAV, net asset value. So simply stated, NAV provides you with an idea that how the performance of your mutual fund is there in the market. Only an idea. You cannot just say that yes, NAV is high, NAV is low, so that's why we should either invest more or withdraw our money. No, there is not a single you can say criteria of decision. You should have an informed choice based on the market trend and the you can say company's health also. Fine. So performance of particular scheme of mutual fund is denoted by NAV. That is for sure. Performance is via the NAV only. The NAV per unit is the market value of securities of a scheme less the expenses incurred on the scheme divided by the total number of units of the scheme on any particular date. So this is the formula which we'll be looking into the further discussion. But yes, let's try to have the formula here. NAV is what? Net asset value. It is simply the market value of the securities. Fine. It is the market value. Market value of the securities which are involved. Fine. One component is this. Less the expenses incurred on the scheme minus the expenses. divided by the total number of units of the scheme. Total number of units. Number of units of a particular scheme, whatever we are talking about, on any particular date. This is the keyword here. NAV is always calculated on a particular date, and it's not like your stock which will go up and go down 24/7. Fine. On a particular date, supposedly 3 p.m. the particular NAV is fixed at 200 units, then only 200 units will be there for today. For next day, it will be recalculated. Right? So on a specific date, you have the NAV, and it is based on the market value of the securities which you are trading inside the mutual funds minus the expenses which has been occurred by the company of yours, divided by the total number of units which have been allocated. Fine. So NAV is required to be disclosed by the mutual funds on regular basis, daily, weekly, depending upon the type of scheme. Normally you will find that it is displayed, it is being disclosed on daily basis, but yes, there is one option that weekly also you can do. Now comes the example via which we will try to see that how this NAV calculation functions. Again, we'll be taking the example of SBI only, right? That how the NAV calculation helps us ultimately. So supposingly we are talking about SBI Nifty index funds, the regular growth. And as on 2nd March 2026, we have seen that in the market, it has reported a NAV of 220.03. This is the NAV, fine. It is rupees 220.03. And whenever there is a NAV which is being presented, you will find that some funds are involved. There will be some funds which are involved. So more or less, how we calculate NAV, which is an indicator of the mutual funds, their performance. So total assets, this includes the market value, the stocks, bonds, the cash, right? The market value of all these instruments of the Nifty 50 stock held, plus any accrued dividends, any profit which they have made, that will also be the part of total asset. Suppose the fund's total asset comes out to be 12,000 crore. Then we calculate the total liabilities. This will include the fund's daily operating expenses, management fee, expense ratio as we call it. When daily operating expenses are there, it's not that you are not providing any amount to your employees and just giving them work. Fine, anything can happen here, and in order to compensate for that particular aspect also, expenses will be there. Any money owed by the company also will be the liability. If the liabilities, let's suppose, come out to be 183.68 crore. So whether the total asset will be directly calculated and taken into account to calculate NAV? No. You must calculate the net asset, fine, which is also known as the AUM of the fund. So the total asset minus liability, which equals to rupees 11816.32, that is 11,816.32 crore. This is your AUM. The fund's AUM is this much, the net asset. Fine, asset under management. Outstanding units, if the total units issued to all the investors are, let's suppose, 53.7 crore units. These are the number of units which you have issued to all the investors, fine, clubbed together under the SBI Nifty index fund, one type of your exchange traded fund also, the index fund you can say. So the formula will stand at what? Total asset minus total liability. That is what? Your net asset, this one. Simply divide 11,816 with the 53.7 crore units. You will get what? The NAV of 220.03. That's how you calculate the NAV. Okay, and that is the reason why we keep on saying that NAV is just telling you that how the fund is behaving, whether it will be profitable or not. You cannot just say that from analyzing these 2 or 3 things. Right? There are n number of things, the market trend you must also read. So first thing first, what do we in fact mean by the insurance, the term insurance? What is the ultimate meaning? Simply stated, you are insured. Fine. It comes from the insured word that you have certain goods with you, fine, certain goods are there, or for that matter certain services are to be provided by some third party, and in this process only we tend to go across various domains. You can have the insurance in the form of life insurance, or for that matter your accidental insurance, and these two schemes in front of you, the screenshot in front of you, it talks about the most important themes of our bank. Also on daily basis bankers have a specific target, and the target goes around the Pradhan Mantri Jeevan Jyoti Bima Yojana as well as Pradhan Mantri Suraksha Bima Yojana. You must be knowing about the schemes, about the specifics of these schemes, but under which process you are providing such services to the public, that is important to know, and we will be deciphering all these things in this particular lecture. So insurance simply you can define as a contact between two parties. So you have party X and party Y, two parties are there, and what kind of contact we are talking about, where some promise is being made. So one party, let's suppose X, will be promising the another party to indemnify or make good any financial loss suffered by the latter. And who will be the latter? The insured one. So if you have one person Y who is insured, fine, this person is insured, whatever loss will be incurred by this person, it will be made or compensated by X, fine, X will be compensating. And what is this process of compensating called? It will be termed as insurance, fine, because we have one insured entity and there will be one particular company which will be providing the compensation, and the entire process is known as insurance. So more or less whenever you talk about the financial loss, or for that matter any kind of insurance, it is termed as this particular compensation, and the compensation ultimately it will be received by the way of some amount. What is this premium? So in this process of insurance you will find the two parties, out of which one party, that is X, will be compensating. And why this party will compensate? Because Y has regularly paid the sum known as premium to this particular party, that is X. So a relationship or a contract between these two parties will be known as insurance when one party is compensating for the losses incurred by the second party. And why these losses will be fulfilled? These losses will be done away via the Y action, the actions of Y, ultimately leading to the insurance. The contract of insurance, it is referred to as a policy. Fine, we have a document, altogether one document is there, and that document will ultimately be termed as what? It will be the contract, and the policy, ultimately we say that this particular contract will have one policy. Fine, and this is what? The policy is what? Policy for a particular contract, right? And the contract is your insurance. So simply stated, insurance is what? A simple contract between X and Y. X being the party who will be compensating Y. Y is the insured person who will be paying the premium amount. Ultimately, the terms of contract will be written in a document which is known as policy. Okay, insurance policy. The car insurance policy, you have the term insurance policy. We have a set of loss, but which particular loss has resulted into the final amount of the compensation, that is not known. Still, we can assume that out of these losses anyone can occur, and if that loss occurs to the insured party, then you will be compensating to them. For this, people facing common risks come together and contribute with fixed amount towards a pool, out of which they are reimbursed if and when the loss occurs. So whenever the loss occurs, you will be only then compensating. It's not like that, that every year you are paying some premium amount and by the end of the year your account will be credited by this premium. No, even if the loss is not occurred, you will receive something. No, it is not an investment plan. It is just a contract between two parties. Fine. Now comes the most important part of the entire unit, that what are the fundamental principles governing these insurance products. So more or less you will find some 5 or 6 important principles which will be governing these insurance plans. And what insurance plans, we'll be learning that also in a bit, in a you can say small discussion in a while. So when we talk about the business of insurance, it aims simply to protect the economic value of assets or life of a person. There are 2 types of insurance majorly. One, protecting the economic value of the asset which a person is holding. It can be what? Your car, it can be your house, it can be your factory, it can be the cargo which you are shipping towards, let's suppose, Iran, or life of a person. Second type of insurance means you are providing what? Some insurance, some compensation towards the loss of life, right? Life insurance. Through a contract of insurance, the insurer agrees to make good any loss on the insured property or the loss of life, as the case may be, that may occur in course of time in consideration for the small premium to be paid by the insured. So what is happening? Simple. X and Y, they enter into a contract. X is being paid via premium, Y is being compensated as per the contract, this contract. Okay, so what are the principles more or less? So apart from our essentials of a valid contract, insurance contracts are subject to additional principles. Principle of utmost faith. What is this utmost faith? That both the parties, X and Y, they have a faith in, let's suppose X is having faith in Y and Y is having faith in X. It's not that you don't have any faith in the insurer, or for that matter the insured person, and still you are providing the services. No, it cannot happen. You must have utmost good faith. Fine, you will be paying the person only based on this. Principle of insurable interest. What is this insurable interest? You must be very much sure that why the insurance is happening. Whether the insurance is for car, whether it is for your life, or for that matter cargo, all these types of insurance must be very much clear. Based on that only, based on the specific interest only, we will be providing the services. Principle of indemnity, this particular term which we were just discussing, any loss. So if the loss has been made to the insured party, then only the insurance company will give you some money. Fine, that is the principle of indemnity. Then comes the principle of subrogation. What is this subrogation? More or less we will be talking about only the 2 parties which are involved, not the third party which will be there. Subrogation will be this particular party. Let's suppose X and Y are 2 parties. X is the insurance company, Y is the insured one, and the third party has given some loss to Y, that is the insured person. So principle of subrogation will be what? That once the insurance contract starts or it has been initiated, X, that is the insurance company, will directly have the recovery from the third party. That is the subrogation principle. Then we have principle of contribution. If we have multiple insurers, then it's not that all these particular insurers will be providing entire amount. No, there will be some proportion, some contribution from each and every insurer. Proximate cause, the cause must be known, that why we are providing. Each one is important, but the most important one is insurable interest and the indemnity. Let's see them one by one with examples. So in case of principle of utmost faith, commonly known as uberem fidei, fine, this is a legal term, uberem fidei, where you will find that both policyholder and insurer must be 100% honest. Being faithful means what? You are ultimately honest to each other, fine. You must disclose every material fact that could affect the risk. All those facts, fine. Whenever you take an insurance policy, you also must have seen that a particular individual, the individual who is providing you the services, that individual will say what? That we will be calling you, and all your medical history should be in front of us before providing you the final quote. Right? Utmost honesty is important. If Rajesh is buying life insurance, has a history of heavy smoking or previous heart ailment, he must tell the insurance company. If he hides it, dies later due to the lung issue, company can legally refuse to pay his family. Fine. If Rajesh upfront on the day 0 only tells that yes, I am suffering from this bad habit of heavy smoking, then chances are there that premium amount might increase, but ultimately the insurance company will be providing the services to this particular family. Fine, all those losses will be actually paid by the insurance company, otherwise they can directly refuse. Okay, so good faith means what? 100% honesty. That is the keyword which you should remember. 100% honesty. Okay, then we have principle of insurable interest. Here simply stated, you are doing what? Only the you can only insure something if it loses, if its loss causes you direct financial hit. Okay, you cannot just say that there is no financial hit to me, no direct financial hit to me, still you want to have the insurance amount in your account. No, nothing of that sort is possible. Only the insurable interest should be reckoned via giving the insurance policy. In that process only. You cannot insure your neighbor's car just to collect money if it crashes. Fine, your neighbor is not knowing anything, and the particular neighbor, supposedly X, he or she is not having any car policy. Let's suppose no car insurance is there, but you on behalf of your neighbor is taking the car insurance policy and then say that yes, since I have paid the premium amount, you give me the insured or the insurance amount involved. No, not at all, not possible. You can buy insurance for your own house, own spouse life, because you have financial stake in them. Fine, financial stake. Always remember, insurable interest does not mean that we are talking about the emotions. No, not possible. We are talking about the finances, and financial loss is the keyword here. You cannot take out the insurance policy on a random celebrity's bungalow in Mumbai and claim once the loss has occurred to them. You are not directly related, right? Next comes the most important one, principle of indemnity. What is this indemnity known as? Simply the meaning, the English words meaning, that is indemnity, is directly replicated in the principle also. Insurance is meant to put you back in the same financial position you were in before the loss, not to make the profit. Fine. A very thin line of difference is there. Whenever I say that supposingly you your 5-year-old scooty is worth 30,000 and it gets stolen. Now if you have the insurance of your scooty, then what will happen? The insurance company will make good your loss. Okay, the insurance company will pay you, let's suppose 30,000, which is the market value. They won't pay you 80,000 to buy a brand new top model of Vespa or the latest scooty, the electric one. Fine. You cannot just say that I need this particular scooty, and since I am your customer, give me the money so that I can buy the latest model. Nothing of that sort is possible. Does not apply to the life insurance. Human life cannot be assigned a replacement price. So principle of indemnity, always be very much mindful while studying on your own also, that this indemnity principle is not applicable on the life insurance. Why? Because in indemnity we are doing what? We are just replacing, fine, replacing the particular loss which has already occurred. Okay, so all these keywords are very important. When I talk about the utmost faith, the uberem fidei, you must remember 100% honesty, utmost good faith. When I talk about the insurable interest, it must have some financial implication over you itself. Directly, it will be impacting you. Then we have the replacement, whether you can replace a particular asset or not and make good the losses which has been occurred by the customer. Then we talk about the principle of indemnity. Fine. Last important one will be your principle of subrogation. Subrogation more or less gives right to the another party. Fine. We are having only two parties. Let's suppose X and Y. X is the insurance company and Y is the customer. Right. Now this customer has been, you can say, considering the losses made by Z. Right. Z is the culprit here, the third party as we call it. Now since Y is insured via company X, Z can directly be sued by the company. Why? Because the insurance provider has this particular principle of subrogation implemented in all the policies which they hold, which the customer is holding. So once the insurance company pays your claim, they take over your right to sue the person who caused the damage to recover their costs. More or less, this is the most important part. Very, very important. Fine. So when we talk about the example here, if a reckless truck driver hits your parked car, your insurer pays you somewhere around 50,000 for repairs. Now, once the payment is done, you cannot just approach the court and say that yes, this reckless truck driver was there, found on the spot, and I want to sue this person because of the act which he or she has done. No, not possible. You cannot then go and sue the truck driver once the insurer has paid you the money to get another 50,000 for yourself. No, you have lost that right. Okay. So the principle of subrogation will be what? The insurance company now has the right to sue the truck driver to get their 50,000 back. Okay. It's not that insurance company wants to you can say enjoy the legal processes. No, they want the recovery from the third party. That's the reason why you will have no role whatsoever once X, that is the insurance company, has given you the amount. Okay. Next is your principle of contribution. Who all can contribute in the insurance process? So contributor will be what? If there are two different companies involved, let's suppose there is a shop and you insure the shop of yours for 10 lakh with LIC, another 10 lakh with HDFC. If you suffer a loss of, let's suppose, 5 lakh. So whether you can go for the compensation of rupees 5 lakh with LIC or HDFC or both or none, what will be the right answer? Under principle of contribution, you cannot get 5 lakh from each. That is a must know. Making it 10 lakh, no, not possible. Either they can each pay you 2.5 lakh or one pays the full amount and then recovers the half from the other. Okay. So this is the contribution made by various insurers, various insurance companies to a single customer. Okay. So the same thing has been written also. If you have insured the same property, two different companies are there, you cannot claim the full amount from both. They will share the loss proportionately. Fine. Proportionately, the losses will be shared. Then we have the principle of proximate cause. What is this proximate cause? That what is the ultimate issue which has caused this particular event. If a loss is caused by a series of events, fine, the nearest one will be taken care, it will be taken into consideration for calculating that whether the insurance company will provide you the money or not. And mostly you will find that such cases, they arise in the marine or the cargo insurance. Fine, because we are moving the cargo from India to, let's suppose, Iran. Now though not Iran, but yes, you can say that via the ports we are moving in the marine insurance, in the marine areas, and we have the marine insurance. Then n number of things can happen. Fine, if you already know that yes, this is the reason because of which the entire cargo had lost its way, or for that matter the entire cargo has been destroyed for the reason that the marine water, it was the main culprit. Secondly, you can say the weather was not conducive. Thirdly, the rats who are on this particular cargo ship, they have created havoc. All these are what? These are the reasons. But what exactly the reason has caused your loss, and whether that particular reason is being highlighted, is being mentioned in your insurance policy or not, that ultimately determines that what will be the compensation. So principle of proximate cause, you must know that which cause is to be considered while calculating the final approval or the amount of compensation. So if a loss is caused by a series of events, nearest or the most direct one is looked at to see the if it is covered by the policy. Now again, the marine insurance, the most apt one here. Imagine your marine insurance covers damage by seawater, but not by the rats. Then if the rats have damaged your entire consignment, whether you will get the money thanks to the principle of indemnity? Answer is no. Why? Because the policy is not covering the damage done by these rats. Okay, if rats chew a hole in the ship and the seawater enters, ruins the cargo, the proximate cause is the rats. The start of the chain is what? Rats only. Since rats aren't covered, the claim might be rejected. Might be, not 100% it will be rejected if the loss has been made by what? Such entities, such parties which are not at all mentioned in the policy document. Okay, very, very important point. Do not miss this one. Proximate cause, actual thing which has caused, and whether that particular reason has been directly mentioned or not, that will be considered. Okay, now let's see that how the questions are asked. More or less, you will find one question based on the principle of indemnity. Always they ask one question from principle of indemnity because it involves minor calculations, fine. So the question would be like this only. Mr. Rajesh owns restaurant which he had bought 3 years ago for rupees 10 lakh. Okay, so what is the price of the restaurant? The restaurant price is your 10 lakh. This is mentioned in the question itself, 10 lakh. Then we have, he bought the fire insurance worth 8 lakh, which is the written down value of his insured property. So more or less you will find what? That the ultimate insurance which has been bought by Rajesh stands at 8 lakh. Okay, so this will be what? The cover, insurance cover as we call it. His restaurant caught fire, he suffered a loss of 6 lakh. What is the loss? Loss is 6 lakh rupees. 6 lakh is the loss. Amount of compensation to be paid by the insurance company will be what? You have to tell me the compensation amount. Simple calculation, simple formula. No need to remember all the formulas, but yes, this formula is important. Fine. So sum insured, that is your what? 8 lakh, divide it by the value of the insured asset. Simply 8 lakh divided by 10 lakh. This is what? Insurance. Fine. This is the insurance cover. Fine. So directly you can do what? The cover, insurance cover, divide it with the price, the property's price, or for that matter the asset's price. Price of the asset you can call it. Here the asset is what? Restaurant. Now once you have divided these two, just simply multiply with the actual loss. Whatever the loss is there, you will put these values and get the answer as 4.8 lakh. Okay, 8 divided by 10 multiply by 6, that will be what? 4.8 lakh. Okay, this is 8 lakh divided by, yes, it will be the actual loss. Fine. In lakhs, 4.8 lakhs will be the right answer. Okay, if you need to calculate also, let's just try to calculate this also. We have 8 divided by 10 multiply by 6 lakh. Okay, this will be, the figure will be in lakhs. Okay, so here we have what? 8 divided by 10 multiply by 6. So you can cancel it out. 4, here it is 5. Cancel this out also. This will be 1. This will be 1.2. So 1.2 multiply by 4. Multiply by 4. This will be equal to what? 4.8. And what is this? 4.8 lakhs. Okay. So like this, simple calculations will be there. Simple formula based questions will be there. You won't be asked big questions, big numericals as we see in the other subjects. Here in IFS, simple questions will be asked, simple formulas will be asked. They will test you on the concepts. Fine. If you understand that how I can calculate, under which particular principle it falls, things are very much easy. Fine. Now comes the various types of insurance businesses. What all insurance businesses are there? More or less, mostly everybody must be knowing that what all types of insurance are there. We have life insurance, providing the insurance for life. Health insurance, providing the insurance for health. Travel insurance, insurance for travel. Fine, you are, let's suppose, going to Canada, fine, and you need to insure yourself, your co-traveler also. Travel insurance is there. Motor insurance, insurance for your vehicle. Then property insurance, insurance for your house. Home loan, in home loan it is mandatory, right? Mandatory ask. Then fire insurance, if the property gets destroyed thanks to the fire, then we have the fire insurance. Burglary insurance, if there is any event of theft, right? The theft has happened, whether you will be relieved or not, yes, because you have the insurance cover. Then we have the marine cargo insurance, like just now we have seen this example where the proximate cause we were discussing about the marine insurance only, that the rats have chewed every cargo item and now you have incurred the loss. Just imagine that your insurance policy already had the rats covered in that particular marine insurance. Then definitely it will be a positive scenario for you. You won't be having any headache. Okay, so in order to have all these covered, you have different types of insurance businesses. Let's just go through the important ones. It starts with the life insurance only, which has 3 sub plans. The various patterns are being noted and we have categorized them in term, whole life and the endowment insurance. Life insurance benefit patterns fit into one or the combination of the following 3 classes. These are the subcategories only of your life insurance. What is the term insurance? Here you will find that it is limited for a number of years. Fine. A term has been assigned to your insurance policy. Fine. What kind of term? This type of insurance furnishes protection for a limited number of years only, terminates with no maturity value. Nobody is providing you anything, right? The maturity value is there, but whether you will be providing the maturity value to somebody or not, no. Once the policy matures, the cover is gone. The face amount of the policy is payable only if the insured's death occurs during the stipulated term. Now the policy, let's suppose, is for 30 years and you survived these 30 years. Whether after 30 years you will be receiving the compensation saying that yes, you have survived the term of this term insurance. No, nobody will be compensating you because you are alive. Nothing is paid in the case of survival. Okay, that is what we have just discussed. Issued for short period, but customarily provides protection for at least a set number of years. Mostly it is for what, 20 years only, what we have seen in the banks also, because of the third party engagement right now in the banks. In the mostly the insurance policies which we sell, it is for 20 years. And one recent example, if you remember, we have seen, I think, Canara Bank, where 100 years, some term was there for 100 years. So don't make such mistakes. More or less 20, 30 years, that's what the plans are. Stipulated age is also prescribed, that up to 65 years of age or 70 years of age, not like 150 years of age, right? It is more comparable to the property and liability insurance contracts than to any other life insurance contract. Fine. Life means what? Insuring the life. So whether you will be getting something, no. That is the reason why we say that it is more comparable to the property. Fine. The property insurance, the insurance of your house, because ultimately after 15 years, mostly the home loan files you must be seeing in your branches, there you will find what? The policies attached to those home loans, and the tenure of those policies more or less is 15 years only. So after the 15 years are passed, do you think that the particular customer will receive the entire amount of premium he or she has paid? No. That is what is going on in your term insurance plan as well. Nobody is compensating for you for the amount which you have, you can say, signed the contract with the insurance company. Only one clause is there, that in case of death, your near and dear ones will be getting the money. That's it. Initial premium rates, they are lower compared to the other life products because period of protection is limited. So we have limited period of protection. It's not an entire 100 years we are talking about. Then comes the interesting one, that is your whole life insurance policies. These are the policies which we don't sell. Fine. In the banks, we don't sell these policies. This is intended to provide insurance protection over one's entire lifetime till you survive. Fine. Till you survive, that will be the clause. for the payment of the face amount upon the insured's death, regardless when the death occurs. If the death is after, let's suppose, 60 years, yes, you will be paid. Universal life policies can function as whole life insurance if they have sufficient cash value. Again, the life policies are there, and these life policies, they can function as the whole life insurance if they involve the cash value, if it is equivalent to these whole life insurance policies. Face amounts payable under the whole life policy typically remains at the same level throughout the insurance policy duration, although dividends are often used to increase the total amount paid on death. Fine. So more or less you will be having the same amount, but over and top of that amount under the whole life policies, you will be getting the sum insured as a higher one because of the larger, or you can say more coverage thanks to the entire lifetime. Then we have endowment plans. What are these endowment plans? You must have heard one particular policy in all the branches that is a mixture of both these two policies, whole life and the term insurance. So unlike the term policies, these promise not only to pay the policy face amount on the death of the insured during a fixed term, but also pay full face amount at the end of the term if the insured survives the term. A mixture, a hybrid kind of thing, you can say. Supposingly you have 20 years, fine, 20 years of term plan. Now this 20 years term plan will do what? It will only suffice if you do not survive this term plan, or for that matter this time duration of 20 years. Only then your family will get the money, na? But what if you survive 20 years? So if you have the endowment insurance policy, then you will also be able to enjoy the money after such time period. Okay, although we do not provide such policies in the banks, because recently RBI has given the direction that you should not promote the cross selling, because mis-selling is happening in the branches. But yes, this is the most common type which we used to offer the customers. The policy has following features. These policies are insured for specific terms chosen by the proposer itself, who can choose the duration, maybe 10, 15, 20 or 30 years. To be noted that whether the assured meets a premature death or not, the full amount of the policy has to be paid by the insurance company, provided the premiums have been paid as stipulated in the policy. Okay.
First thing first, what is pension? If you have to answer me in a single line, you will say that pension is certain corpus which you will be making for the retirement. Fine, a particular corpus which has been assigned to you either by your employer, or you have made it possible throughout your career that after I retire, I should be able to enjoy my retirement corpus. And more or less, if the particular retirement corpus is given to you on a regular interval after the retirement is there, that particular corpus will be called as pension. Fine, that is how we perceive pension as a concept. But nonetheless, when we talk about the origin story of pension, it was not from day one known as the retirement corpus. So what was that? Let's see. The word pension, it originates from the Latin term known as pensio, fine, which was which has the meaning that is payment or paying. You have to pay somebody something, which stems from pendere, meaning to weigh or to hang. You have to understand that earlier, whenever the payments were done, they were in cash, or barter system was there. So in order to accomplish something from whatever goods or services you are giving, that will be exchanged via a certain payment of either goods, or for that matter payment of some items in lieu of another item. It evolved to describe payments made by weight under the barter system, specifically referring to rent, tribute, or a regular stipend. So regularly you will be having some amount involved, and you will providing that particular amount to some person, right? And this pensio later on became the word pension only. It entered the Middle English recorded before 1325 via the Old French pension, fine pension as we call it in the French language, transitioning from a journal payment to a specific regular allowance for retirement. So earlier we were talking about what? Only the payment, a journal payment, fine, that was known as pensio. But later on in 1300s, it evolved as a regular payment, and regular payment for all the people, no, only after the retirement you will be having certain regular payment, which is now known as pension. Okay, so the origin starts way back in the barter system, ultimately culminating into the pension. Fine. So when you talk about the pension and its aspects, what all you must remember. See, more or less the system everybody knows that what is a pension system. It is like a corpus which you are holding for your retirement days. That's it. And aspects means what all important factors are there by which we can say that yes, you must enter into the pension product system. So pension, it simply provides monthly income to the people during their unproductive years, whether they are unproductive or not, more or less as compared to the earlier journey where they started their career. Yes, these are the unproductive years only. Pension is necessary for the following reasons. What all reasons are mentioned? So more or less we know that due to the decreased income earning potential at a later stage of your you can say life, that is your age is increasing, you are turning 60 or 60 plus, and ultimately you find yourself in a position where you no longer can earn with that enthusiasm which you were doing earlier. Fine. Similarly, when you talk about the rise of nuclear family, ultimately earlier we used to have the families are close knit and they used to help each other. But now when we talk about today's world, the nuclear family are there, everybody is independent from each other's responsibilities. So at an age where you are unable to earn that much, you need certain corpus, right? Migration of earning members, all those members who are earning in your family, they are going to their own places of work, the workplace changes, so you are left alone. Rise in the cost of living, now we do not find anybody who is having simpler living. Find simpler living in the sense that nowadays the expenses are way higher, although the inflation rate is not high in our country right now, but the rates are very high, the productive rates are very very high for all those services which we are seeking. Increased longevity is there. Fine. When you talk about good health care, it comes with this particular aspect also, that earlier the when we talk about just after independence, our you can say age was not that high. The average age in our country was not that high. It was merely 33, 34, but now it has risen to 72, and sometimes you will find that some data will point out that it is beyond 72 also. So yes, such things are happening more or less. Why they are happening? Because we know that the healthcare system has established itself in a positive manner. Then we have dignified life in the old age due to the less financial dependency. We want that our the children are now more or less working. They are earning on their own. Now we want to live freely. So for that, what we need? We need some funds. So pension is there for you. So all these aspects, all these reasons are there via which we say that yes, pension is important for our old age people. Now comes that, okay, we understood that these are the pointers via which we are reiterating the fact that yes, pension is important. But what about the schemes via which you will be implementing these pension systems? So more or less, the pension schemes, they are three or four the major ones. Else, when we talk about the entire globe, worldwide, these schemes will vary. But for India, we have EPF, PPF, NPS, APY, and insurance annuity schemes. But mostly, the examiner will be asking you from the NPS and APY. But let's just have an overview of each of them. So firstly, it starts with the Employees Provident Fund, the EPF we are talking about. So more or less, this EPF is having single benefit that for the salaried staff, it is a mandatory saving. Normally we think that okay, we will be opening one separate account from which is different from our account where the salary is disbursed, and we will be keeping the money there. But normally what happens, the habit of savings is not there thanks to the huge expenses, huge monthly expenses. So what you can do, ultimately you can switch to the EPF, fine, a particular provident fund where on regular basis you have to save, fine, you don't have any option, you have to save under the EPF scheme. Risk level is quite low because backed by EPFO. Now the interest or the returns, they will be varying. They, you cannot say that they are directly fixed, or for that matter more or less they are having a fixed rate of interest always. No, there is a range. But yes, as per the market trend, you can call them as a fixed one as compared to some others like NPS is quite variable in nature. But for the EPF, more or less it has a range, yes, but it is not fluctuating that much. Then comes the public provident fund, the PPF. Here, government backed tax free savings you will get. Now, tax free savings for what? More or less we are talking about such items, or for that matter such savings where the tax is not applicable. You will be depositing some certain amount of money in the PPF, and you will be free of any kind of tax on those savings. And why it is important, or for that matter why it used to be that much lucrative? Because of the interest rate. 7.1 used to be a big interest rate as compared to the other schemes. But now when you talk about today's world, everybody knows mutual funds is the most you can say it is having the highest rate of return. But nonetheless that involves risk also, and for the old age people we don't suggest that indulge in the mutual funds if you do not know how to trade. So for the PPF, when you are in your job, start saving small amounts and take the benefit of this low risk and fixed rate of interest, which is 7.1. NPS, National Pension System, more or less it is the market linked retirement fund only. Fine, it is not direct government scheme, but you can say that the government is regulating this scheme. Fine, it because the fund is having a fixed rate of interest when it is backed by the government itself, like we have PPF, or for that matter EPF also, the autonomous body. But NPS, although you will find that yes, government role is there, but it is not fixed. The retirement fund value is not fixed by the government, it is fixed by the market. So market forces will be deciding the ultimate game. Next, when we talk about the risk level, it is moderate because government is not involved here. For the rate of interest, we talk about it varies 9 to 12%. And you can say that NPS is such a scheme where the variation is quite high as compared to EPF and PPF. Then comes your Atal Pension Yojana, the you can say one of the flagship scheme of Government of India, that is APY. Why it was launched? The primary benefit was guaranteed pension for the unorganized sector. We have some citizens of our country who are working where in the unorganized sector also. So what about them? Because they are not covered under the EPF or PPF, or for that matter, they don't have the access to NPS. So for them, we have the Atal Pension Yojana. A fixed pension will be provided to you between the range of 1,000 and 5,000 rupees. Risk level is very low, no risk whatsoever because it is backed by government. Then comes the annuity schemes. In the insurance chapter also we have seen the annuity schemes where you will find that regular income is there for life. And various schemes are there. They will provide you regular income for your entire lifetime. Risk level is again very low, and it varies by insurance provider. Right? Various insurance providers, they have different annuity schemes. So more or less these are the primary schemes which you should remember for your exam also, and being an aware citizen of our country. Now comes the first scheme, that is your EPF. What is EPF? We will be dealing with EPF throughout this particular session. Fine. So EPF, more or less it talks about the employees provident funds, right? Just give me a moment. Let me just So, when you talk about the provident funds, there are various types of funding mechanism. There are various types of funding mechanism via which you will provide the retirement corpus to the employees, fine, employees of your company. And one such scheme is your EPF. It is not only an optional but mandatory pension scheme for the private sector and is managed by the EPFO, Employees Provident Fund Organization. More or less, the establishment goes way back in 1952, which covers the employees in specified economic sectors at the firms with more than 20 employees. So, all those firms where the number of employees is more than 20, you have to have the mandatory EPF implemented in your firm. So they can ask you the year-based question also. Remember, 1958 will be the 1952 will be the right answer. It is what statutory body, fine, formed under a certain statute of Government of India. So statutory body under the Ministry of Labor, Government of India, responsible for regulation and management of the provident funds in India. More or less, the provident funds, every type of provident fund which is being utilized in our country, they will be managed by the EPFO. The EPFO administers the mandatory provident fund while outsourcing the management of the scheme's asset to fund managers. Like in mutual fund, we have seen that there are certain fund managers who are just managing the fund. Similar is the case with the EPF scheme also, where EPFO will be doing what? Administering the mandatory provident fund, and the management of those funds will be done by the fund managers. And when we talk about who are these managers, whether we will be hiring a team, no. Traditionally, these assets are managed by the PSU banks itself. Fine, all those PSU banks which you have, we will be having direct involvement as managers. Fine, we will be managing the funds. Employers can be exempted from the participation if the pension plans provide at least the same level of the benefits. Now, when you talk about it is mandatory scheme for the private sector, but here is a catch that if a particular company in the private sector they have a better scheme as compared to the EPF, then they are exempted. Fine. Otherwise, it is mandatory. And what are these? You can say exempted funds. We'll be looking into you can say after 5 or 10 minutes in this particular lecture only about the exempted funds also. So taking into account your Employees Provident Fund and Miscellaneous Provisions Act 1952, the schemes of EPFO, they are administered by tripartite board called as the Central Board of Trustees. So when you talk about the EPFO, more or less, the administration will be done, the EPF administration will be done by the EPFO, and the administration will be done by a single individual, chairperson, or some board. A board will be formed known as the Central Board of Trustees. So CBT will be doing the administration. Next, when we talk about the EPF scheme in detail, you will find that the composition of the board is directly mentioned in the scheme document also. So the board comprises representatives of government, both central as well as state, the employers as well as the employees. So mark this very, very important that state government also have the representatives in the board, the CBT. The board is chaired by the Ministry of Labor and Employment, Government of India. Again, the Government of India is directly involved here. But what is the most important point? It is that the EPFO operates on the following three major schemes. In case you don't know that the EPF scheme is there, alongside two more schemes. One is EPS, the pension scheme, and another one is EDLIS, your employees deposit linked insurance scheme. So a total, or you can say the culmination of all these three schemes is offered by whom? By the EPFO. So what are the different you can say aspects of these schemes? Let's see one by one. For the Provident Fund, the EPF, employee share is 12%, employer share is 3.67%, total comes out to be 15.67%. That is the most common one. The particular scheme which is not very well known, it is your EDLIS, the insurance part. Here, employee share is nil, no employees contributing here, and that is the reason why we don't know about EDLI that much. The employer share is very small, but yes, it is there. So it is 0.50, and ultimately the total comes out to be 0.50, which is being invested in the EDLIS, your employees deposit linked insurance scheme. Then comes the EPS, where the employee share is nil. Fine, this everybody knows. Employer share is 8.33%, which is capped. Fine, it is not having any fluctuation. It is maintained like this only, and the total comes out to be 8.33% itself. Fine. Now let's move on to the next topic. EPF, more or less, they will be asking questions from whatever we have discussed, and you need to revise some things like the three schemes, the major schemes, the board, the CBT, what all composition is there, who will be chairing this board, fine, whether some in chairman will be elected or directly ministry will be involved. So ministry is directly involved here. EPFO was having a direct relationship with the EPS scheme, that you must know. When it was established, fine. So the particular scheme established in 1952, and what all sectors are involved. So private sector, it is important, but exemption is also there, which we'll be learning in a while. Next, we talk about the Yuan number. This is an account number sort of setup, which everybody must have accessed, because it is available for all the employees. And specifically, the public sector bank employees, they deal with such type of Yuan numbers on regular basis because of the you can say attachment with the EPFO's provident fund. Fine. So EPFO introduced your Yuan number, which acts as an umbrella for multiple member IDs allotted to an individual by different employers. Fine, different employers. You switch from one bank to another, then from one bank to another private company, then from another private company to, let's suppose, one corporate. So all these employers will be having what, a direct tie-up with the EPFO, because more or less they are private employees via the private companies. And when we talk about the member IDs, all these member IDs will be different, but Yuan will be what? It will act as a single ID, which will be having all these IDs, the member IDs, the multiple member IDs, which has been allotted by the different employers to you. So what is the purpose of Yuan? It is basically for simplification, fine, linking all the multiple EPF accounts into one. So it is what, unique 12-digit number assigned to an employee by EPFO, and it enables what, the linking of multiple EPF accounts. Various accounts are there, EPF accounts are there, and you are allocating what, those particular EPF accounts will be having a specific member ID. Fine. And this Yuan will enable the linking of all those multiple accounts allotted to a single member. Fine. So that there is no confusion whatsoever with the employee, or for that matter employer. The Yuan program was launched in 2014 as part of Pandit Deen Dayal Upadhyay Shramev Jayate Karyakram. Both the employee and your employer, they should contribute 12% of the employee salary for the EPF, that everybody knows. The employer's matching contribution are allocated across EPF and EPS, such that 3.67% goes to EPF, remaining 8.33 goes to the EPS. Fine. So 3.67% we have seen it goes to EPF, and 8.33% it goes to the EPS, the employer share. Fine. Now, when you talk about the exempted funds, what are these exempted funds? Let's talk about the characteristics of these funds. So, more or less, again, as the word suggests, if you are having a better scheme as a private company, you are having a better scheme, then you are exempted from maintaining the EPF account. Fine. The EPFO will say that yes, you can carry forward with your own specific scheme. Fine. So it refers to the provident fund trusts managed internally by the specific establishments rather than the central EPFO. So whether it gives complete independence to the establishments? No, not at all. You will have to follow the investment guidelines of EPFO still. They are exempted from contributing to the central PF, yeah, fine, the CPF as we call it, but they are not exempted from the law. The laws will be applicable. They must strictly follow the EPFO's investment guidelines, audit requirements, the reporting standards, everything will be there. What is the rationale of exempted funds? In order to provide a free path for the establishments to do whatever they want to do for their employees, fine, in order to provide them the retirement corpus. The exempted funds can be established as a substitute for the EPFO plans, provided the benefits at least match the ones of the EPFO plans and that the EPFO approves setting up the exempted funds. Fine. So exempted funds must be approved. That is the first important point. Who will be approving? EPFO will be approving. You will submit a plan as an establishment. I want my establishment to have this setup, this type of provident fund, and if EPFO approves, you can provide it to your employees. If employers set up the exempted funds to substitute the EPFO, the employees must participate in that particular scheme. They are established as independent trust and governed by the employer and employee representatives as trustees. Fine. So again, we will be having it as a trust only, and you will find that employer and your employees representative, not all the employees, but the representatives of your employees will be treated as trustees of that particular fund. Contribution level, they are same as EPFO has the same EPS system and must provide the same rate of return also. If you have a better plan, you well and good, but minimum it should be the same rate of interest, the same return minimum should be provided as there is in the EPF scheme. The retirement age, it varies because in some private establishments it's 58, somewhere it is 60 also, so it might differ. When you talk about the tax deductions here, so employer and the employee contribution, they are tax deductible and investment income is tax exempted. Fine. So the contribution, you have to deduct the tax, whatever the contribution you are making, your employee and employer. But when we talk about the investment income, the income, finally generated income, is tax exempt. No type of tax will be there. There are stringent investment regulations for the exempted funds that specify minimum investment limits. So there will be some type of regulations provided by the EPFO. And what are these stipulations or the regulations? The investment regulations, because in exempted funds also you have to honor the investment regulations by EPFO. So the regulations are as follows. 25% of the asset must be invested in central government bonds. Right? So where you have to invest the money in the central government bonds, 25% of the fund. 15% of your asset in the state government bonds or the bonds of public sector enterprises, PSCs as we call them, guaranteed by central or state governments. 30% required to be invested in the bonds of public financial institutions or the public sector enterprises. So more or less 25% goes to the central government bonds. 15% of the assets invested in state government bonds, or for that matter, the public sector enterprises bonds, which are guaranteed by some government backing of either government of India or your state government. The 30% specifically, they are required to be invested in the bonds of public financial institutions, the public sector enterprises. Fine, the bonds we are talking about, the bonds of your PFIs, the bonds of your PSEs. Okay, so yes, that's how you should remember the percentages, because they will be asking you such question in the exam also. The remaining can be invested in the same asset categories. Fine, remaining whatever you want to do, you can within these particular asset categories. Since 98, you will find that the trustees have had the option of investing a maximum of 10% in the private sector bonds. Fine. So more or less, the maximum limit is 10% only for the private sector bonds, the investment which you can do. Okay, so this was it for today's class. When you talk about the concepts, we will be learning some questions also, doing some questions also after this information which I'll be giving you. But nonetheless, if you have any doubt, feel free to ask me in the comment section. Now, these concepts which we have learned here, they will be limited ones, because ultimately the entire lecture for IFS, or for that matter, the entire subject of IFS for other subjects also, you need to enroll in our paid classes. And right now, the Mahapack offers you the best deal. Why? Because here you get the daily live classes. You will be having the recorded videos also. Mock tests, the unit-wise mock test and the full-length mock test series is also provided. Plus the PDFs, the free PDFs from where we are giving you the lectures, that will also be attached in every video. So all these you can get, and if you want to know more about this batch, just call us on the number 0981 981 9247. And for maximum discounts, do not forget to apply the discount code Y1003. This is the discount code. Now let's see the questions. So with reference to the universal account number, that is Yuan, consider the following statements. It is a unique 10-digit number assigned to an employee by the EPFO. 10-digit number or 12-digit, what is the right answer? Acts as an umbrella for multiple member IDs allotted to an individual by different employers. Yes. The Yuan number, the Yuan program launched in October 2014 under the Pandit Deen Dayal Upadhyay Shramev Jayate Karyakram. So the right answer will be what? Option B, 2 and 3. Because what is the number in the Yuan scheme? So the number is 12 digit. Fine. So do remember the number of digits, which is 12. Fine. B will be the right answer. Other two options are correct. With reference to exempted funds under the Provident Fund system, consider the following statement. So exempted funds are important. Why? Because they have not asked any question from here. And in November 2025, we have seen that some statements they have asked from the erstwhile not so important topics. Okay, so they are managed internally by the specific establishments instead of your central EPFO, right? These funds are exempt from following the EPFO's investment guideline. No, that this is not correct. They have to follow the investment guidelines 25, 15, 30%, 10% for private sector. They are established as independent trusts governed by both the employer and employee representatives. So correct answer will be 1 and 3. Right answer is option C. Okay. Last question, with reference to the investment regulations for exempted funds, consider the following statements. 25% of the assets must be invested in central government bonds. Yes, fine. We have seen that. 15% of the assets must be invested in the state government bonds or guaranteed public sector enterprises. Public sector enterprises bonds. There is a mandatory requirement to invest 40% of the asset in private sector bonds. It is what? 10% only. Fine. Maximum is 10%, which has been allowed by the EPFO. Okay, so the right answer will be 1 and 2. Option A is correct. First, you can say definition only with the definition of parabanking. What is this parabanking? See, when I talk about the simple function of banks, it will be either to take money, that is to take the deposits from the customers, or for that matter, lend money, that is to provide loan to the customer. These are the two primary functions performed by the banks. But right now, when we talk about the various financial services, they are already being provided by many big banks, fine, like the insurance services, like the mutual funds, like being a broker for a particular person, individual who wants to invest in some security in the financial market. So all these are what? These clubbed together are known as the para banking services. So when we try to define it, it is a very simple definition. Para banking and the financial services activities, they refer to those activities carried out by a bank which are other than their normal day-to-day activities. What are these normal day-to-day activities? We have the deposits, withdrawals, giving credit, etc. Fine. These are the primary activities, and apart from these two activities, whatever the services are being provided, even the cross-selling of the products, the targets which you get for the third-party insurance, that is also under the para banking. These services were earlier named as para banking services. And when we talk about when this particular definition was given to these services, the para banking services, it was mentioned in the RBI's master circular of 1st July 2015. Ultimately, RBI expanded the scope of these services by adding various types of financial services, financial activities. So RBI, in its master direction of 2016, further expanded the scope of these services by adding the following financial activities. What all activities were added? So more or less the investment advisory services. Fine. When we talk about the advisory services, just try to recall this keyword which we have studied in the previous lecture of merchant banking. So more or less we are talking about what? The merchant banks, the merchant bankers, because these banks only provide the services via some subsidiary to their clients. Fine. The banks, SBI, ICICI, HDFC, they are doing what? Via one subsidiary, they will be providing the merchant banking services also. And these merchant banking services are what? Simply the advisory, the consultancy of various wealthy individuals or big corporates, that how they should invest in the market. Fine. So more or less this is merchant banking. Then agency business by the banks. So principal agent. Fine. You must be knowing that in PPB we have studied one relationship, the banker customer relationship, and the first and the foremost which we saw was creditor debtor, debtor creditor. Another important one was principal and the agent. Who will act as the principal? The customer. And who will act as an agent of this principal? The bank. So all those services provided by the bank on behalf of their customer, that will be termed as the agency business done by the banks. Then we have the broking services for commodity trading segment. Fine. So broking means what? You are acting as a broker. The bank is acting as a broker because the trade will happen between a company and an investor. Company raising the money, investor investing the money. But whether it is a direct trade, no. In between you have a broker, and in India, or for that matter in any part of the world, you will find that the brokerage services are provided by the banks themselves. Fine. The depositories are different from the brokerage system which we have seen in the capital market, but for the purpose of parabanking services, you need to remember that broking services for all those commodity trading is also a part of this particular type of service. Fine. So majorly these three are the you can say pillars of the parabanking in our country, defined by RBI in 2016. Now some examples of parabanking services are in front of us. We have bancassurance. Fine. The most you can say not so popular, unpopular belief in the banking industry, that you have to sell life, health and non-life insurance products. Thanks to this introduction of bancassurance. Right. Then we have the portfolio management services, the PMS as we call it. You are managing the investment portfolio for your clients. Then mutual funds, distributing or sponsoring the mutual fund products. Right. This is also one of the part of our daily targets, right, which we get. Okay. Then we have factoring and leasing. You are providing certain services, certain alternate to the credit in the form of factoring, or for that matter leasing. So equipment leasing, hire purchase services, all these are also what? Under the parabanking services provided by the banks. Then credit card business, the subsidiary of SBI, or for that matter Axis Bank, will be having some credit card involved in their entire business network, and these are also sold via what? Via the bank only. You must be knowing that in most of the public sector banks you will find that within the branch only one dedicated person is there who has the target of selling the credit card also. So credit card business, again parabanking services, issuing the credit card. Debit card, so you cannot say that it is a part of parabanking services only, because it is the part of core services. But yes, in the overall scenario across the globe, you can say that different variants of debit cards are also there. Right? Not only one single debit card is there. So issuing debit or credit card often via the subsidiaries. Then primary dealership. Who are the primary dealers? The standalone primary dealers as we call them. Fine. And the non-standalone or the simple primary dealers, where the banks are also involved. So you are doing what? Retailing the government securities. The trade in the government securities will be done by whom? By the primary dealers, and banks act as the primary dealers, and ultimately they are involved with the RBI, because RBI on behalf of the government will be selling, or for that matter initiating the buying cycle of the government securities. Okay, so all these are what? These are the services which banks provide apart from their core business of deposit and lending. Now comes the journal guidelines. See, in this entire chapter, if you are studying on your own also, let me just tell you one thing. In the parabanking services, not everything is important because we have already learned them. Fine, all these things we have already learned, like bank assurance, we have learned where? In the insurance product chapter. When we talk about mutual funds, the dedicated chapter was there. Factoring, forfeiting, leasing, another chapter was there. Your credit card business, more or less, has been covered in PPB also. Primary dealers, specifically mentioned in another chapter. So all these in detail you already know. Just for the parabanking services chapter, what you should focus? You must focus upon the regulations. You must focus upon the data points. That is, if that is it. If you are focusing on these data points, you are good to go for this unit number 44th. So all these guidelines are important. Fine. So like when you talk about if certain bank wants to enter into parabanking services, any kind of parabanking services, so which law, which statute will govern that? So the banks desirous of undertaking the business permitted under the section 6 clause 1 of the Banking Regulation Act 1949 may do so either departmentally or through a separate subsidiary set up for that purpose under the provision of section 19 clause 1 of the Banking Regulation Act. So if you are a bank and you want to start some business apart from deposits and your advances, then what you can do, you can open a separate department within your bank. Within the banks, a separate department will be there, or for that matter, you can also engage some subsidiary of yours for undertaking the business. And this particular subsidiary which you have to set up for this purpose, it is in line with the section 19 clause 1 mentioned in the Banking Regulation Act, right? So all those businesses which are permitted to the banks, which they can undertake, they are mentioned in the section 6 clause 1. And when we talk about the separate subsidiary which you have to set up, or for that matter some department you have to set up separately, that is mentioned where? Under the section 19 of the Banking Regulation Act. Fine. So more or less from here you have to remember these two sections, and this entire chapter talks about various sections which are important. An activity undertaken departmentally shall follow RBI guidelines on KYC compliance, Charter of the Consumer Rights issued. Fine. So KYC compliance must be adhered to. In addition to all the instructions, regulations of respective regulators such as SEBI, IRDAI, PFRDA as applicable shall also be complied with. And why? Because we are talking about the para banking services. Like in mutual funds, you will find that SEBI is directly involved. So being a bank, the regulator is RBI. But since you are providing the services of mutual funds, you must be under the supervision of SEBI also. You must comply with all those rules of SEBI as well. Same goes for bank assurance. So IRDAI is there for the insurance regulation, fine, the regulator of insurance products in our country. So more or less bank assurance, if you want to take, then IRDAI rules will be applicable like that. Now comes the limits on the investments. How much you can invest, how much you can retain, how much you can expand your business. Whether you can have a full-fledged para-banking branch in a particular city or metropolitan city. Fine. Yes or no? No, you cannot have that, right? So all this is mentioned in the limits on the investments, how much you can invest. So equity investment in a subsidiary company or the financial services company not being a subsidiary means when we talk about the investment you are making as a bank, you are doing what? Subsidiary company is there and the company is direct linked to the bank itself. Fine. Now you want to invest in that particular subsidiary company. So what type of investment? What is the threshold of that investment? So individually, if a bank wants to invest, the entire investment should not be more than 10% of the bank's paid up share capital. 10% is the upper limit as per the last audited balance sheet or subsequent balance sheet, whichever is lower. So paid up capital, we will be looking where? In the balance sheet. Which one? Audited or subsequent? The last audited one, or for that matter, subsequent balance sheet also. Whichever is lower. Both of these values will be there in front of you. The value which is lower, that value will be picked for calculating this 10%. Fine. That is the maximum investment you can do in the subsidiary company. When we talk about the individual, fine, individual investment. But for the aggregate equity investment in various subsidiaries, this was for one subsidiary. But aggregate, how much you can do? The aggregate of equity investment in factoring subsidiaries, factoring companies shall not exceed 10% of the bank's paid up capital and reserves. Again, when you talk about the aggregate also, it should also not exceed this 10%. Fine. So this is very important for the examination, that you remember. Singularly, individually also it is 10%. Fine. 10% of the bank's paid up capital. And when we talk about the aggregate number also, it is more or less kept similar in the form of 10% again. Bank shall not contribute more than 49% of the equity of your infrastructure debt fund set up as the NBFCs. So when you talk about the NBFCs, which we have covered in the previous chapters also, there you must have seen that there is one type of fund, IDF, which is being set up by the NBFCs. There, banks cannot contribute more than 49%. 49% is the threshold limit. A bank contributing less than 30% of the equity of IDF NBFC shall not be a sponsor bank. Fine. If you are contributing more than 30%, then only you will become a sponsor bank. If you are not contributing beyond 30%, you are not. And moreover, when we talk about the upper limit, it cannot be beyond 49%, because primarily, so we are doing what? We are doing the business of NBFCs. Right? We are talking about the business of NBFCs. If you are having the equity more than 49, or for that matter 50 or 51, then either you are the equity holder with the equal rights 50%, or you are the majority holder with major rights. Okay, so that should not be the case. Then comes the restriction on the exposure. What all restrictions are there? Because like the limit on investment is important, the restrictions on the exposure is also important, that you are exposing your balance sheet, your bank's balance sheet for these parabanking services, then you must be very much careful about the exposure also in the market. So banks are not allowed to hold more than 10% in the equity of the deposit taking NBFCs other than the housing finance companies. For HFC, the norms differ, but in general, we say that 10% is the upper limit for the banks. Fine, they are not allowed to hold beyond 10%. Further, the bank should not invest more than 10% of the unit capital of your real estate investment trust, infrastructure investment trust, subject to the overall ceiling of 20% of its net worth, permitted for direct investments in your shares, convertible bonds, debentures, mutual funds, or the AIF, alternative investment funds. So when I talk about the overall investment which you are trying to make in some via some trust, that is your real estate investment trust or the infrastructure investment trust, the overall ceiling will be 20% of the net worth. Right? And the net worth will be calculated via the direct investments of your bank in the shares, in your convertible bonds, debentures, mutual funds, or the AIFs. Fine. So banks should not invest more than 10% of the unit capital. The capital will come from where? From these trusts. And the overall ceiling is 20% of the net worth. Besides, banks should not hold more than 10% of the paid up capital of a company, not being its subsidiary engaged in the non-financial services, your NFCs, or for that matter, you can say NBFCs, or 10% of the bank's paid up capital and reserve, whichever is lower. So just to keep it simple, you have to remember that banks cannot have the investments or the exposure in their subsidiaries beyond 10% of the paid up capital for that particular company. Why? Because ultimately the banks are also at risk if the subsidiary fails to make the business. Okay, so 10% is the limit there also. Now comes the overall investment. When we talk about supposedly the investment is in excess of 10%, but within the limit of 30% of the paid up share capital of such investee company, they shall be permissible if the investee company is engaged in non-financial activities, only for those companies which are non-financial in nature. So we can have the investments beyond 10% also, and greater than 10% also, but up to 30% is the cap. Fine, not beyond 30%. And when when only and only when it is a non-financial activity company. Banks should not hold along with their subsidiaries, associates, joint ventures, or any type of entity directly or indirectly controlled by the bank. So it means that you should not have any direct contact with your subsidiary. You should not be managing your subsidiaries. You should not be managing the joint venture, right? Banks as a bank. Okay, which are controlled by the bank. More than 20% of the investee companies paid up share capital engaged in the non-financial services. Fine, 20% you can control. Otherwise, beyond 20%, no, it is not at all acceptable. Then we have the important restriction, because we are talking about the restriction thanks to the market regulator, that is SEBI. So any investment by the banks in by a bank's subsidiary in category 3, that is your alternative investment fund, shall be governed by SEBI regulations. And when we talk about the category 3 AIF, it is governed by what? SEBI. And ultimately bank is regulated by whom? Bank is regulated by the RBI. So that is the rationale where we say that banks are not allowed to invest in these AIF. Right? Banks are not allowed. Prior permission of the RBI, yes, it is required before making the investment of more than 10% of the paid up capital or the unit capital in your category 1, category 2 AIF, alternative investment fund. So more or less, when we talk about the RBI, it is involved only in the paid up capital for your category 1 and category 2. Right? Only in the AIF funds, we have category 1 and 2 inclined towards the RBI. When we say that we want to invest in the category 3 or of your AIF, then SEBI is involved. So banks will be able to make investment here also in your category 2 and 1, but with one caveat, with one restriction, that prior permission is required. Then we have the bank's aggregate equity investments, which are made in all the subsidiaries and other entities engaged in the financial services and non-financial services, including your overseas investment. It should not exceed 20% of the bank's paid up share capital. Again, 20% is the limit whenever we talk about the investments, the aggregate equity investment in each and every subsidiary, whether it is engaged in financial services or non-financial services. And the investment here includes the foreign investments also, overseas investments also, and the overall aggregate amount should not exceed 20% of your bank's paid up share capital, and investments in excess of 10% in the non-financial companies acquired through restructuring of debt or to protect the bank's interest on loans and investments. Fine. So if you have a specific company which is formed just for one purpose, that we want to restructure the debt using this particular non-financial company, there also banks cannot have the investments more than 10%. Again, very, very important point. From here, they can ask a question also. Now comes the prior approval. So RBI's prior approval is required when in the category 1 and 2. Also, when you talk about the prior approval, it is required in various you can say services, or for that matter various conditions, various circumstances. But one important point is here that the RBI's approval, prior approval, is not required in the HTM category. So if the investments in the financial services companies are held under the held for trading category, HTM category, and they are not held beyond 90 days, you will say what? Simply, you will say that we are only doing what? We just want to have this trade ongoing. We just want to have the particular profit and exit the market. We are not here for a longer duration. So you are holding a particular trade, a particular commodity only till certain period of time. So debt or equity investments purchased with the intent of selling them in the near term, in just about, let's suppose, 15 or 20 days to make a profit. Fine. Usually it is less than a year only, but ultimately when we talk about the real market scenario, it is way less than 1 year also. Fine. So more or less 90 days is the maximum cap which is being given by the RBI and your SEBI also. So the particular companies which are held under the held for trading category, they are not held beyond 90 days. If beyond 90 days, then again RBI's approval will be required. If not, if within 90 days you are selling off the particular commodities and exiting the market, making the profit, then no need for the prior approval. Now comes the primary dealership. Fine, we have seen that primary dealership is discussed in the previous chapter also, but here in this unit there are certain criteria which are mentioned by the IIBF. So those criteria are important for us. For undertaking primary dealer business through a subsidiary, a bank should be registered as NBFC with the RBI. So NBFC with RBI. And ultimately, when we talk about the primary dealership, they are having what direct hold with the client. Fine, the client is there and you are providing the dealership, or for that matter services, to your clients. There are various types of you can say primary dealers. We'll be looking into that also, but first and the foremost thing, if a bank requires or wants to become a primary dealer, that which of the criterias they must fulfill. First of all, minimum net owned fund should be 1000 crore. Fine, first thing is you should register as NBFC with the RBI. Secondly, when we talk about the NOF, it should be 1000 crore. So who will register as the NBFC? The subsidiary. Fine, the subsidiary, because banks are directly not participating in the primary dealership. Via subsidiaries they are going. So minimum NOF is 1000 crore. Minimum CRAR is your 9%. Net NPAs of less than 3%, and the profit making record for the last 3 years. These three criterias must be fulfilled. Only then you can apply or become a primary dealer in India. Right? So more or less this particular this particular criteria must be satisfied. Only then you will be allowed to become the primary dealer. REITs, or for that matter InvITs. Before dwelling into that particular topic, let's just see that why we need to have the discussion around real estate, or for that matter infrastructure. Because see, whenever there is a nation building exercise ongoing, you will find that any kind of developing economy, it requires these two critical sectors. It has majorly two critical sectors via which ultimately the tag of developed nation we can have. So the infrastructure of a particular country, that will determine what will be the growth rate. How? So simply stated, when you have a good infrastructure, a country with a very good infrastructure, so the development of the infra is directly proportional to your growth rate. And why we keep on saying this? Because whenever the investment is long term, because in infrastructure projects the investment will be in the long term, the assets which are created via these infrastructure investments, you will be utilizing it, the common man. And ultimately, whenever you are utilizing that, you are paying for the usage as well. So from that particular payment you will be providing to the government. The government have some kind of surplus money, surplus, you can say, funds, and those funds government will be able to apply for the various economic activities. And these economic activities will be again done by us only, the employees only of various companies. So ultimately you will be landing up in a particular job. You will be having your own identity in the case of income. So specific income will be there. Once a specific income is there, we will be having some corpus for the savings also. So once the savings is there in your corpus, you will find yourself in a position to invest in these particular types of instruments, ultimately creating an asset of your own. So it starts off with the infrastructural building, but ultimately you will find that the critical sectors of your economy will be these two only. Fine. So infrastructure, more or less, it replicates its own growth. So real estate as well as infra, these are the two most critical sectors. Then we talk about the well-developed infrastructure, which is the key driver for all the overall development of a country. Whenever the infrastructure development happens, you will find that people are getting employment also in those infrastructural activities. Plus, once the infrastructure is developed, fully developed, you will be having certain part of that infrastructure earmarked for the government as well, and the funding will start again. So for a well developed infrastructure, why we keep on saying that it will be treated as a key driver for the overall development of the country? Because of this simple reason. Now comes the real estate sector. Why the real estate sector is also a fundamental sector for the growth? Because you as an individual will be directly dealing with these real estate, you can say, parties, or for that matter, real estate sector. A well developed infrastructural setup propels the overall development of the country also. It also facilitates steady inflow of private foreign investment. So more you are having well versed knowledge about the infrastructure, the more you will be learning about the infrastructure, the more you are inclined towards the well defined examples. The world class infrastructure will be a reality via the investments also. So the private investment, foreign investment, they will keep in, and thereby augments the capital base available for the growth of your key sectors in the economy, as well as its own growth in a sustained manner. So when we talk about a particular infrastructural project, you will find yourself into a position wherein you can invest also and ultimately earn also from that investment, and whatever you have earned then again reinvest it in some other project. So more or less a cyclical approach, you can say, is there whenever we talk about the infrastructure and real estate. And this is the reason why we keep on saying that the trusts which involve these two important sectors, the critical sectors for the developing economy, they are important to understand. Fine. So here we start our discussion with the real estate investment trusts. So as in mutual funds, here also you will find that we are talking about what? The pooling of resources. The resources will be pooled by various individual investors. So REITs, or for that matter infrastructure investment trust, they are what? These are the investments which some individuals will be doing. In the real estate, everybody knows that yes, we can buy the house, we can have the commercial property in our name. But what if somebody is not having that much money? What if somebody just wants the infrastructure, the real estate investment in their kitty? For them, we have the REITs. So these are just the stock market listed investments that allow the investors to have the exposure for the real estate without having to purchase or manage the properties by themselves. So no need to manage, no need to purchase as such the properties. What you are doing, you are just buying certain stakes in these investments. So these are like mutual funds only. Like in mutual funds, we have what? Various individual investors, various entities will come together and they will pool their resources. Similarly, in REITs also, you will find that these REITs permit the investors to pool their resources, and the assets are managed by a designated person in charge. So who will be this designated person? The trustee again. But while underlying asset of your mutual fund is equity, debt, gold, or a combination of these types of assets, in case of REITs, it is what? Real estate holding, or the real estate loans which are secured by the real estate. So ultimately, it is a type of the setup in the REITs is a type of mutual fund only. Like in mutual fund, you are investing via the pool of funds, but one important differentiation is that while in mutual funds you have different types of assets, fine, underlying assets, be it equity, debt, gold, or the combination of these debt and equity. Then gold has certain combinations, but here in REITs you will find that primarily we are only dealing with the real estate holding, or for that matter the loans which are secured by the real estate. So what is the structure? The structure looks like a mutual fund only. Like there you have the sponsor, here also we have a sponsor. There you have one management company, here also we are having a management company. Ultimately, a trust will be formed in the mutual fund. Here also we have a trust. Fine. So like that, we can say that overall the structure is same, and this is the reason why we keep on saying that more or less the entire structure of REITs looks like your mutual funds. The trust owns the real estate properties on behalf of the beneficiary unit holders and is responsible for protecting the interests of these unit holders. Whenever we talk about the interest of the unit holders, who will be ensuring this out of sponsor, trust, or for that matter, management company? The trust will be ensuring this thing, and via the trustees, they will be appointing some individual entities also, so that the individuals who are investing in these REITs, their interest does not go in vain. The management company, it is vested with the responsibility of managing the real estate portfolio. Again, the same thing which used to happen in the mutual fund also. Right? The management company is doing what? They are simply managing your real estate portfolio. In mutual fund, they were managing what? They were managing your equity portfolio, your debt portfolio. Here, in case of the real estate investment trust, they are doing what? They are simply managing your real estate portfolio. And such a tripartite arrangement, tripartite means what? Three parties are involved, that is sponsor, management company, and a trust. Via this structure, you are providing what? A safety net for the investors, that they should not lose their money whatsoever. The income of REITs, from where do you earn? From REITs. By investing in REITs, you must be earning something. That is the reason why you are investing here. Otherwise, you could have gone to the actual market and bought some real estate property. But here it comes in the form of rental income as well as sometimes from the sale also. So the underlying asset is what? Underlying asset is the real estate holdings and the loans which are secured by the real estate. So once we talk about the rental income from these investments, that is your earning, that is your income. Also, the capital gains, the gains which you will be making after selling off such property, the real estate properties, they are also your income in case of REITs. And the profit is derived by adjusting for various costs associated with the management of your real estate portfolio, plus the fee for various professionals including your management company and trustees. You will be providing certain fees for the management company, for the trustees. Adjusting all those fees and the costs which are associated with this management company, you will have the profit. The final amount which you will be having is the profit you made out of the REITs. Now comes a very important point wherein we will be studying the difference between REIT, the direct property ownership, when we talk about the physical real estate company equity, where you are doing what? Some kind of mutual fund is involved, which is having the equity structure of a real estate company, or for that matter, corporate property bond. A particular corporate is there and they are issuing the bond, and under which particular segment? The property. So, what is the type of investment in all of them? In REITs, we know that it has units in a listed trust or the share of corporation owning the real estate. Simply, you are owning the real estate. And what kind of real estate? The physical real estate? No, only the units in a listed trust or the share of this particular real who of a particular corporation which is actually owning the real estate. So corporation is owning the real estate and you are doing what? You are owning or you are investing the units in the listed trust or the share of this corporation. The direct property ownership, you are directly investing in the physical real estate, buying a house, buying a property. Real estate company equity. Now, what do we mean by this company equity? Simply stated, the type of investment will be shares of your listed company who is owning the real estate and other businesses. Fine. So you are investing in the listed company's share, and that listed company is doing what? That listed company is the owner of the real estate and some other businesses. So that is why we call it as real estate company equity. Then comes the corporate property bond. More or less, the debt will be their debt instrument will be there. So debt issued by the underlying real estate company. So whenever the debt is being issued by the underlying real estate company via the corporate bonds, that type of investment will be your real estate investment, which we are doing where? In the corporate market. Now comes the payout, that how you will be paying the money. So majority of the taxable income paid to the unit holders. Fine. So the unit holders will be having the money once the profit is there for the corporation. When we talk about the direct property ownership, like we try to buy a certain house, majority of the income is paid to the owner only. Fine. So the owner will be having the majority of the income once the property is sold. Real estate company, in case of equity, you will be having some dividends to the you will be providing some dividends, the profit to the shareholders. And for the corporate bonds, since we are talking about the fixed income market, you will be having fixed payout on a regular basis. So what is the investment strategy? in the direct property ownership, what is your investment strategy? Even if you are not residing in that property, your strategy is that let me just buy this property so that I have a particular asset in my name. So that is your focused activity for which you are buying a property. Similar is the case with REIT, that you are very much focused that yes, via the profit I make from these REITs, I will be doing what? Doing some other investment. But in case of your real estate company, in the equity case scenario, or for that matter, your corporate property bond, the corporate market, you will find that these investment strategies, they vary not only on the individual but determined by the company board. Whosoever is leading this board, their directions will be implemented by the entire equity, or for that matter, the listed company. Fine. So in both these cases, same thing. Investment choices determined by the company board. Now, what about the liquidity? Whether we can easily liquidate all these assets? The answer is no. Only in case of REITs and your equities type of setup, the real estate company equity, you will find that liquidity is more or less high. Fine. High in comparison to direct property ownership and the corporate property bonds. So when we talk about the corporate property bonds, it is having low liquid investment. And there is a very important clause which most of us know as illiquid investment, which comes where? In the actual property. Whenever you are buying an actual property, you will find that there is no liquidity whatsoever. In REITs, what is the diversity? So portfolio diversification is there because it is just like a mutual fund. In case of real estate equity company also, you will find the diverse portfolio is there. But in case of property ownership, or for that matter, your corporate property bonds, the concentration risk is there because you are doing what? You are making payments for a fixed asset. That is your direct property. Only in one asset you are doing the investments. In REITs, you are buying what? You are doing the trade in the units only. That is why the portfolio is diverse. Same goes for your corporate bond also. Fixed income, long tenure, you are doing what? The concentration risk is there. Because overall, if we see that after year on year basis, if the investment is not that good, not that great, it will pose a risk of concentration itself. Then the risks, fine, after the diversity, let's move on to the risks altogether. So REITs, the perceived low risk is there, high risk is there in case of your actual property ownership. For equity also, it is high risk, and for corporate bonds, it is low risk. More or less, the REITs, when we talk about the regulations, so the gearing is limited by these regulations only. What is this gearing? That how much you are providing the ultimate return, whether you are satisfied with this return or not. So it is limited by the regulations only. In case of ownership, direct ownership, you will find that it ranges between 70 to 80%. For equity investment, moderate level is there, 60 to 70%. And for the corporate property bond, it is again moderate gearing level. So more or less, we have to understand that this particular table, whenever you see this table and you find any kind of extreme measures, extreme parameters, then you must note them down. And when we talk about the extreme parameters here, they are like this. The liquidity illiquid investment is where in the direct property ownership. Which of the following is having the highest risk or perceived high risk is there? So direct property ownership has high risk and your real estate company equity has the high risk. Fine. So the risk appetite will be governed by the gearing also, more or less. Fine. So a particular measure of your company's financial only, that what will be the risk in the overall market. Now let's see the invites. What are these invites? Again, infrastructure investment trusts. So these are again trusts only. Like we have the REITs, they are also trusts. Invites are also types of trust. Okay, okay. So if you have any doubt, feel free to ask me in the comment section. Now, whenever we talk about the investment trusts, you will find that majorly it is more or less inclined or linked to the real estate. But there are certain projects where you want the common people, the masses, to be included in those investments which are hitherto only reserved for the big corporations. So here comes the infrastructure investment trust. So these are listed investments again that allow the investors to become stakeholders in the infra developmental activities of the nation. Whenever you are talking about the infra developmental activities, you must have one thing in mind, which we have studied in module A also, all those infrastructural activities which are ongoing in the country. What is the main objective of invites? It is simply to provide the retail investors, the individual investors like us, with the access to investment opportunities in the infrastructure projects, all those infrastructure projects wherein they can invest. Earlier, they were not at all involved because they were reserved for the large institutional investors only. They are similar to the mutual funds or for that matter REITs, but they invest in infrastructure assets like roads, power transmission lines, etc. Fine. So more or less the risk appetite will be same as we compare it with the REITs or for that matter mutual funds, but the underlying asset will change. In case of mutual fund, it was debt equity. In case of REITs, it was real estate projects. But in case of invites, it will be road projects, railway projects, power transmission lines like that. And one of the famous invite is your National Highways Infra Trust that is being sponsored by the NHAI, National Highways Authority of India, backed by the government to manage the national highways. So like this various types of investment trusts will be there, not only in your infra investment, but also in the real estate. Now comes a point that okay, we know that is a particular definition of infrastructure investment trust, but what about the income? Why the investors should be making money and how? So simply stated, the investors in your invites, they earn returns in two ways only. First is regular distribution and through potential capital appreciation. Whenever there is a regular distribution of the stakes of the dividends, you will find yourself in a position that you will earn something. Similarly, for the capital appreciation also, you will be having the ultimate income for the investors. But what about those investors who have invested in real estate also and in the infrastructure also? Do let me know in the chat section. Invites typically distribute most of the earnings to the investors in the form of dividends. Fine. So this will be what? Regular distribution of dividends only, which can provide a regular income stream. In addition, the underlying assets appreciate in the value over time. Investors can potentially sell their units for a profit. Some type of profit you want to make, you can, but after selling the units in your invites. Okay, now let's move on to the advantages of both these investment trusts. Why you should pick these trusts over some other investment options available in the market? Because of primarily four reasons. One is the low ticket size. The investors can invest small amounts also in these financial instruments. So the ticket size is way lesser as compared to some other instruments. Liquidity is there, fine. As the units of REITs invites are listed on the stock exchanges, there is reasonable liquidity and your exit option is always open for both the existing as well as the new investors. On the stock exchange, normally when we talk about the listing of some assets which you can trade on, that is provided with an exit option as well. And here also the same scenario happens. So liquidity is much more higher as compared to some other options available in the market. Transparency is there. An investor can easily know where the money is invested as well as what would be the fair value of the investment as the NAV is declared regularly, just like your mutual funds. Regulations, so they are regulated by SEBI only, which sets the rules and regulations governing their formation and operation. Again, backed by SEBI, and the investors will not lose their money. That is the ultimate aim of the regulator. So low ticket size, liquidity is high, you have the transparency as well as regulated market. Okay, so this was it for your infrastructure and real estate investment trusts. I hope that you are able to understand each and every point which we discussed. Now we will be talking about some questions also. There will be some questions related to whatever we have discussed. But let me just remind you one thing, that if you are our YouTube user and you find the sessions intriguing, interesting, I would highly recommend you to consider our JAIIB Mahapack, because here not only you will get the live classes but the recorded videos also in your study portal. Plus, as the time approaches for the examination, you will find the regular batches, along with that some revision classes also if you are a Mahapack user. Along with that, the mock test series, the full length mock test, unit wise test, everything is provided here. So for that you can directly call us on a number, that is 0981 981 9247, and for best deals on the courses you can directly apply the discount code Y1003. In any case, you want to have discussion around the batches, you can directly call on this helpline number. Okay, now let's move on to the questions. First question in front of us: which of the following investment types is characterized by high gearing, typically between 70% to 80%, and carries a perceived high risk? So the gearing is also high, along with the risk is also immense. So what will be the right answer here? REITs, or for that matter, real estate company equity, direct property ownership, or corporate property bonds? What is the correct answer here? We have just seen the table, and that table tells us that mostly the perceived highest risk is in the direct property ownership. Why? Because of the lesser liquidity also. Right? This will be much more higher. You cannot just exit this setup, but when you are holding the REITs, the sell off the units, move on to the next security arrangement. So C will be the right answer, that is direct property ownership. Then a fixed payout is primary characteristic of which real estate investment instrument? Which of the following will be the right answer? Fixed payout you will be having in the corporate property bond, REITs, real estate company, or direct property. The primary characteristic we are talking about, because fixed payout will be there in many, but what all have the fixed payout as the primary characteristics? The right answer is again corporate property bonds. Fine, they have the fixed payout, the fixed income. In terms of liquidity, how do REITs differ from the direct property ownership according to the standard investment classification? So what is the real difference, real deal here? How the REITs differ from your direct property ownership? Simply stated, REITs, they are illiquid while direct property is liquid. No, that's not the case. Both are considered highly liquid investment. Again, not at all acceptable. REITs are liquid investments, whereas direct property is considered as illiquid. That you can say is a right option. REITs have low liquidity, direct property has more liquidity. So the right answer is what? Option C again. REITs, you must remember the primary difference in case of liquidity will be that they are highly liquid, whereas direct property is illiquid. It is considered as illiquid. Last question: under which investment structure is the investment strategy primarily determined by the company board rather than a specific focused activity? Whether it is REITs and the direct property ownership, your real estate company equity and corporate property bonds, REITs and corporate property bonds, or direct property ownership and the real estate company equity, the focused activity. Fine. We are not talking about the focused activity, but the company board. When you are investing based on the whims and fancies of a company board. So the right answer for this question will be option B, real estate company equity and the corporate property bonds. REITs and direct property ownership, it is for what? For the focused activity. Right? So yes, this was it for today's session. If you have any difficulty, feel free to ask me in the comment section.